and today is Tuesday, it's July 23rd, 2024. It's been an eventful week, and we're live on YouTube and LinkedIn. We really have to get our Facebook thing working again.
Yes.
Uh, Apparently, they changed their policy, and we've never pushed anybody to like our page. You need like 100 followers or something. I don't know. Uh, it's the whole thing. But
We
we
will
are
work on
live.
that.
We are live on YouTube and LinkedIn. And yeah, so today is office hours. Normally we do like a Q&A kind of thing, but I thought that since we've had all the events for the last week politically, that it would be good to go over some tax proposals on the candidates' sides. So we're going to do that. Today we're going to talk about Trump's and his ideas behind the tax proposals that he's put out there over the last couple of months. And some things have changed, and now that he is the official nominee of the Republican Party, and up until Sunday, was it Saturday, I don't know,
Yep.
Joe Biden had his proposals, and then he said he's not seeking re-election. So for the moment, everybody is assuming that Harris is going to be the nominee, but that is no guarantee. The Democrat convention is in middle of August, I think. So I don't know, 2 or 3 weeks, something like that. And anything can happen there as far as who ends up coming out the other side as the actual nominee and who's going to appear on ballots. So depending on what all that is, we'll see what their tax ideas are. A few months ago, Biden had released a tax proposal for his 2025 budget, and it was like the 700-page document of explanations and suggested changes, and some of them are horrendous. And well, we don't know at this point if Harris were the nominee and whether or not she is on board with all those things. Probably, but we don't know for sure. So today we're just going to focus about Trump. And RFK is not going to win. So, so I'm not going to spend much time analyzing his stuff. All right, but let's jump into it. Let me make sure that the streams are working. Let's view on YouTube. How about that? Oh, that seems to be live. Okay. All right, so I'm going to assume LinkedIn is working as well because it's all tied to the same system. Alrighty, so let's go ahead and get started. I've got Serena here with me. She is up there. Uh,
Hello.
so yeah, I'll give you the 60-second quick version. Who we are, how this whole thing came to be. Back in 2000, 24 years ago, 24 years and a couple months, I realized that the whole corporate world was not going to work for me. And so I started my own entrepreneurial journey and had its ups and downs. And then several years later, around 2007, I started getting nasty letters from the IRS saying that I owed them over $1 million. And like most people who get nasty letters from the IRS, I ignored it. And I ignored it. And then they started taking money out of my paychecks that I was getting at the time. And so I was like, oh, I got to take care of this. So in fixing my own problems, I ended up being introduced to this whole Wall Street tax world. And, through some great mentorship, I learned a lot. And, over the past, 15 years-ish, I've done, 50,000 tax returns and billions of dollars worth of, client earnings and saving people, millions and millions every year. So in 2019, I founded Tax Sherpa, and the goal or the mission of Tax Sherpa is to help my tribe. So my tribe are the people like me, basically, the people who either can't or won't get a job and want to do their
Right.
own thing, whether that's temperamentally or just because they have a bigger vision for themselves rather than working as an employee for somebody else. So the solopreneurs, the independent contractors, the small business owners, those people are getting just raked over the coals when it comes to taxes. And the reason is actually somewhat easy to understand. So Serena and I are both in these high-end mastermind groups as far as tax professionals and stuff. And Serena, I don't know if you saw it in the general channel on the Slack. Somebody got a contract for $120,000 this past week. Um, Somebody else got like a $98,000 contract. And by contract, we mean the fees that they're charging to the clients. And
Right.
so, great for them. And, they are focused on the people who can pay those kinds of fees. And that
Right.
is not the small business people. That's not the solopreneurs. That's not the independent contractors. That's the larger businesses. You got to be making, millions before can have those kinds of tax swings in most cases. Occasionally you can do it less, but usually on the higher end of there. And so that's who they aim to serve. And that's fine. Those people need service too. And
Right.
so, by default, the people who are earning, that solopreneur kind of money, uh, the only choice that they have is like, well, I can't pay $98,000, so I go to my local tax guy or the corner strip mall place or whatever it is, and those people, they are how do I put this nicely? They're doing what we call compliance work. They're filling out the forms,
Right.
which needs to be done, but you're not creating any real value there because you're just filling out the forms. Where the value is created is by thinking ahead, by planning during the year for what is coming so that we can manage everything and do it in the most tax efficient way possible. So uh those solopreneurs and those small business owners, they don't have that option, and by default they go to these other places that are just doing the compliance work, and they say, okay, you owe $40,000. It's like, what the hell, man? Yes.
Right.
So that's where tax Sherpa comes in. We serve that people, that middle people that are getting squeezed out, and so that one, these are the people that I understand. Uh, the second thing is that these are the people that actually make America run, and the third thing is that we can make a huge difference for people in that group. And typically we'll see tax savings of 20, 30, 40, $50,000 just regularly, just off the cuff. Sometimes more, very rarely less, but
Right.
just depends on their situations. So that's why Tax Sherpa is here, is to help all those people. And if you're in that group, then we can do a lot of work for you. All right. So I like this quote: "Quality of our questions determines the quality of our life." I think that is very true.
So
And the
true.
internet, if the internet said Tony Robbins said it, which maybe he did, I don't know, but that's I've not really asked who said it. I've not investigated that. I've not tried to find the first utterance of that particular phrase because it doesn't matter to me. It doesn't affect my quality of life. So it's not one of my questions. But I do have a question, and that is, what is really the root problem with overpaying on your taxes? And to me, the root problem is you're wasting 20% of your life, 74 days a year.
Right.
Because what happens if you go to work, whatever it is you do, go to work, you do your thing, you make money, you come home, and you take that money and you ship it off to the government. Who did you actually work for that day? To me, you worked for the government. You weren't working for yourself. You
Hmm.
weren't working for your family. You weren't working for your community. You weren't working for your future. Nothing. You were just
Right.
working for like an employee for the government.
Right.
And so, you know, if you are doing that more than you have to, as as best as we can arrange things, that are covered by the tax code and legal and compliant and all that kind of stuff, then you are just wasting those days.
Right.
And we see people all the time going from a 35% tax rate when you factor in federal income, state income, self-employment tax, or payroll taxes, all these different things. We see people all the time go from a 35% rate overall down to like a 15% rate. That's a 20% delta. And what's 20% of the year? That's 74 days.
Right.
So the real advantage to getting your tax world in order is not just the money, although the money's great, but it's more about the time. So that's 74 days you get back for yourself to do with whatever you want, whether that is work more in your business, whether that's take a vacation, or spend time with your kids, whatever it is. you know Whatever you choose to do is automatically going to be better than working for the government, as far as I'm concerned. So to me, that's the core issue with overpaying is just loss of life, honestly.
All right. Yeah.
All right. But with that said, I do have the answer to all tax questions.
Right.
And the answer to all tax question is, Serena,
It depends.
it depends.
Right.
It depends on everybody's individual facts and circumstances.
Yep.
What is true for you may not be true for somebody else. Um, one of my favorite examples of this was we had a guy in what year was this? It was a while ago. It's probably like 2013, something like that. And uh, he was in South Florida, and he had bought 4 or 5 rental properties. And obviously, South Florida was hit super hard in the GFC, Great Financial Crisis, and he ended up losing all these properties. And you know, the when you have a mortgage on a property and then you don't pay it back, you get a cancellation of debt 1099, 1099-C. And there is and that counts as income basically because when you borrow money, you don't pay income taxes on it because it's a loan, you owe it back. But then when you don't pay it back and the lending organization decides we're just not collecting on this or we're not able to, then it becomes income at that point in that future time period. So if he borrowed the money in 2007 and then it was written off in 2013 or whatever it was, then it becomes income in 2013. So, however, he also lost the properties. So normally that would be a loss against that income. And the IRS ended up arguing about this because the issue was, is this a capital loss or an ordinary loss? Capital loss, you're limited to $3,000 a year. And if you have like $600,000 worth of 1099 income, that doesn't help you any. But if it's an ordinary loss, you take the full amount. So, uh, and what it came down to was whether he was engaged in the trade or business of rental real estate. And we had to argue with the IRS about this, and basically we won because if you have 5 properties, you are in a trade or business. This isn't just like a happenstance kind of thing. You are doing the business of real estate, and so we were right, and we ended up able to save him tons of money. But it was going to be like $200,000 worth of taxes, if we hadn't won that. But it came down to that client's facts and circumstances as far as how much real estate is enough to count as a trade or business, rather than just like if you moved out of a house and you happen to rent it, are you really in a trade or business? Maybe, but it's
Right.
more debatable than if you have 5 that were purchased for the purpose of renting out. So that's just one example. There's a million of them. But it really depends on the particular facts and circumstances that you are dealing with. So, with that said, let's go ahead and look at Donald Trump's tax proposals. So, the Tax Foundation, taxfoundation.org, put together this tracking 2024 presidential tax plans page, and they had just updated it today, putting Harris in the Democrat spot. And if you look here, it just says under all these different topics to be determined. And she may continue the same policies put forth in the fiscal year 2025 budget. And maybe they will, maybe they won't. But for now, we're just going to talk about Trump because he has actually put together some actual comments, and there's actually been updates since this page has been published. So what they did here, which I like, is they kind of broke it down by different topic. And so we'll just run through it, and maybe if we have time at the end, we'll do a couple questions.
Sounds good.
All right. So topic number 1: business taxes. So Trump is proposing lowering the corporate income tax rate from 21 to 20%. And since this has been published, he's actually done 1 or 2 interviews last week, I think it was, where he actually wants to move it from 21% to 15%. So what this is talking about is the corporate income rates. That's for C corporations. So most companies in America are pass-through entities, meaning that they don't pay taxes themselves. The income passes through to the individual owners, and the owners pay taxes as part of their whole tax picture. when everything gets combined. C corporations, though, are they stand alone, so they have their own income, they have their own expenses, they have their own income taxes, and so before the Tax Cut and Jobs Act, the rates, the tax rates on corporate income were in the 30s. It was like 35%, I think it was. And that was a huge problem because, in order to get money out of a corporation, like if you're an owner of a C Corp, whether it's a closely held C Corp or whether it is like you own a share of Apple Computer, which is also a C Corporation, all stock trading on the stock markets, those are all C Corps. In order to get money out of that, you have to take a dividend. And the C corporation does not get to deduct that dividend payment as an expense. So let's just say C corporation brings in $1 million. It has $700,000 of expenses. We got $300,000 net. Okay, so that $300,000, the C corporation is going to pay tax on that. And then if you take that 300 out as a dividend, the person receiving the dividend is then going to have to pay a dividend tax on that income. So it gets taxed twice. It gets taxed at the corporate level, gets taxed again at the dividend level for the individual. And if you've ever heard about double taxation, that's what it's talking about. So under pre 2017 or 2018, really, it was 35% at the corporate level, and then at the individual level, you're going to be paying, either 0, 15, or 20%, or maybe 24%. So at the higher levels, you're talking about 55, 60% plus state tax. So it was hugely punishing to have corporate profits basically and to take dividends from corporate profits. And so that's really what started the financial engineering of stock buybacks, because that was a more efficient use of capital for companies compared to issuing dividends. So, um, and that has had all kinds of bad effects on the stock markets. Well, bad effects as far as I'm concerned, because it's, companies got more interested in playing with the numbers rather than generating real profits. But that's a whole other conversation. So, in the Tax Cut and Jobs Act, which was the Trump tax reform in 2017, they lowered it from 35% to 21%. So there's still the double taxation. So 21% at the federal level for the corporation, plus the dividend, and the dividend you might be paying 0, 15, or 20%. So if you kind of take a middle case, 21% corporate, 15% individual, you add those two together, now you're talking 36%, which is comparable to the highest individual rates of 35 and 37%. So by pushing the corporate tax rate down, it brought the net dividend benefit in line with just regular other income. Uh, and so that's where we are currently. And the Tax Cut and Jobs Act is going to be expiring here in a couple of years. And once it expires, rates are going to go back to where they were before. So he's talking about lowering from 21 to 20 and possibly to 15, like he said in his recent interview. And that would just make it that much more attractive. One, to have C corporations, and two, to take dividends out of them. So, is that a huge, shifter as far as like, how much do you want to, how much do you want to have a C corporation versus an S corporation or partnership or whatever? It's going to move the math a little bit because there is a break even number, basically. When we look at setting up clients with, especially new entities, there's some math that goes into it. It's like, well, how much are you making, and how do we want to treat that? And basically, just as a rough number, if you're making less than $500,000, usually it's better to be a pass-through, like an S corp or a partnership. If you're making over that, a lot of times the math switches, and you're looking at better off being a C corp. It also depends on what you want to do with your company. So if you plan on selling your company and you want to take advantage of some of the incentives to sell companies that are in the tax code, like 1202 exclusions, then you want to have a C corporation. So there's a lot of considerations that go into it. By reducing the corporate income tax, you make it a little bit more attractive. That's kind of the net result there. So it's not a huge mover, but it'll help. The next topic area they had was capital gains and dividend taxes. No tax policy is proposed. So he hasn't said anything specifically. Now, during Trump's third year, I think it was. So it would have been 2019, I guess, or 20. Yeah, I think it's 2019. There was a rumor or a proposal that had been floated out about changing capital gains calculations, not the tax itself, but the calculations for gains to be inflation adjusted. And that never went anywhere, but I hope to see that come back. So the problem with capital gains taxes is that depending on what year you put money into an investment, whatever kind of asset it is, could be a building, could be a stock, could be a business, whatever. So you put money in, that creates your cost basis, and then you have a difference, right? And that becomes your gain. So uh, currently, those tax rates, if you've held the asset for more than a year, then the tax rates, depending on how much income you have for that year, are 0%, 15%, or 20%. It's always going to be less than your ordinary income rate, which is your current income. However, uh, that number that you have for cost is not inflation adjusted. So I've seen cases where somebody held Apple stock, for example, for 30 years, and the cost basis from way back then is incredibly low. However, if you inflation adjust that amount, then the cost basis increases dramatically. Like it can triple, for example. I've seen cases of that. And if you are paying, if when you calculate your gains, if you're paying the 0, 15, or 20%, plus maybe Obamacare taxes of an extra 3.8%, when you're calculating those gains, and then you're paying tax on that nominal amount, that does not factor in the fact that you lost purchasing power from that asset level from whatever time in the past it was. And that's kind of hard to kind of visualize. But just last year, right? We saw 10% inflation. Okay. So if you bought something for $100 and you sold it this year for 108, then you have a paper gain of 8, right? But your $100 is actually worth less now. So to buy the equivalent thing now would actually be 110. So in real terms, you lost $2, but in nominal terms, you gained 8, and you got to pay tax on the 8. So I would love to see that inflation adjustment proposal come back for capital gains. I don't. There's been no rumblings about it, but it was a proposal before, so hopefully it can be again. Then the next category, credits, deductions, and exemptions. No tax policy is proposed. We'll get into exemptions here in a second, but credits and deductions, pretty straightforward. They exist. So just so people understand, a deduction is is a is a reduction of your income. So let's say your adjusted gross income from all sources is $100,000. A deduction is going to change that 100 to something less. So let's say it changes to 95, and then your taxes get assessed on that 95. A credit is after your income is established, after your tax is established on that income, then the credit reduces the tax owed. So are we doing it before taxes assessed or after? That's the difference between deduction and credit. On estate and wealth taxes, make the expiring estate tax cuts from the 2017 Tax Cut and Jobs Act permanent. So this does not apply to all that many people, but if you have a decent size estate, then this will matter to you. Basically, the Tax Cut and Jobs Act doubled the estate tax exclusion. So estate taxes are, or the death tax, as a lot of people call it, is the tax that is owed on estates of people that have died that are over a certain amount. So you get the first however much tax free goes to your heirs, and then they get a step up in basis, and then above that it's basically a 50% tax. So under the old rules pre Tax Cut and Jobs Act, it was the numbers change every year, but it was say 5.5 million, and then the Tax Cut and Jobs Act doubled it to 11 million. And so what the proposal here is making those expiring estate tax cuts, again, because we have a 10-year window on the Tax Cut and Jobs Act. Those are expiring in 2026, and they're going to revert back to that $5 million level. So making the doubling of the estate tax exclusion permanent, which will obviously make the vast majority of estate taxes, or the vast majority of estates tax free. Now, when it comes to the estate tax overall, it's a stupid tax, honestly, because it raises next to no revenue. If you look at the charts, there's just nothing there. So it's just, I don't know why they bother, to be honest. Um, it's sort of what I call feel good policy, where, it sounds like you're sticking it to the rich guy, but, there are strategies for dealing with the estate tax. You create charitable entities and you create foundations and all these kind of things. And you basically, by the time you pass, assuming that you are not passing suddenly, um, then your estate doesn't qualify for estate tax, and that's just how it's done. So it's creating more work for estate planning lawyers. So I guess there's that. If you are an estate planning lawyer, I mean, you guys do good work. But it would be better if it just weren't necessary at all. At least that's my take on it. Excise taxes. Tax large private university endowments. So this is from all the controversy with the colleges, Harvard and Yale, that have like multi-billion-dollar hedge funds essentially, and they get preferred tax treatment. And with all the political controversy over the last year, the proposal is to remove those advantages that they have. So they would have to pay taxes like any other private corporation. That's obviously not going to affect anybody except those groups. So not worth really getting into here. The big one is the individual income tax section. So making the expiring individual income tax cuts from the 2017 Tax Cut and Jobs Act permanent. So this is a lot of stuff. A lot of changes with the Tax Cut and Jobs Act. So one is that the rates and brackets changed. The second thing is that the standard deduction was doubled and exemptions were eliminated. So the standard deduction is based on your filing status, whether you're single, head of household, married filing joint, married filing separate. Qualifying widow or widower is just married filing joint, essentially for a couple extra years. So what happened was, under the old system, you had a standard deduction based on your filing status, and then you had an exemption deduction, which was based on the number of people in your tax household, and it was like $4,000. So, as a single person, you would have a standard deduction of $6,000, then you have an exemption of one person of $4,000, and the total there was $10,000. And basically, under the Tax Cut and Jobs Act, that was replaced by just a flat $10,000. And I'm rounding for all these examples. And then if you were married, then your deduction was larger. And the thing that tweaked people was that if you were married and had several children, then the new standard deduction was less than the old standard deduction plus exemptions. If you had only father and spouse and maybe one kid, then the new standard deduction was higher than the old standard deduction and the exemptions. So, whether it worked out for you or not kind of depended on how many people were in your tax household. So that was kind of a big adjustment. And back then, the payroll companies did a terrible job of figuring out the math ahead of time. So a lot of people ended up owing in those early years of this law change compared to where they were before, because the withholdings were all screwed up. That's been pretty much ironed out by this point. Pretty much. Some people still screw it up. But so that was just one of the big adjustments. Another adjustment was the cap on SALT, state and local taxes. So the standard deduction gets compared against what's called the itemized deductions. Itemized consists of medical expenses above a certain amount compared to your income. Local taxes, like if you pay income tax in your state, that would be a state and local tax. Or if you live in a state like Florida where there is no state income tax, but you do pay sales taxes, you can pick up the sales taxes that you pay, real estate taxes. So all those state and local taxes under the old system were unlimited. So if you're a high income earner in New York and you pay $60,000 in state taxes, which I have seen, then you can get a $60,000 deduction on your federal income for that tax that you paid to the state. Under the Tax Cut and Jobs Act, that was capped at $10,000. So the high income earners in those high tax states got absolutely railed, and
Right.
you know, so that is you know as unfair as I think that is. Like politically, it was like a masterstroke because all those high tax areas, well, they vote Democrat, and obviously Trump was a Republican, is
Mhm.
was a primary Republican. And so it was a way to punish Democrat states and reward, Republican states. So it was politically was a masterstroke, but obviously a lot of people in those Democrat areas are unhappy about it. And the Democrats have been in a tough position ever since because, on the one hand, they have high income supporters in those high tax states that have been agitating to get this $10,000 cap removed so they could go back to the old system where they could take their full deduction on their state and local taxes. But on the other hand, Democrats, don't want to be seen to be favoring rich people because that's their messaging, Uh, to date, they have not gotten anything accomplished on that $10,000 cap. Um, Other things that go into itemized deductions are mortgage interest for your personal residence, charitable contributions, and a big factor that was changed in the Tax Cut and Jobs Act was that under the old system, you were able to deduct one was casualty losses. So, like if your house flooded and you had to do like $30,000 worth of repairs, that's deductible. Under the Tax Cut and Jobs Act, it's only deductible if you are in a federally declared disaster area. So, if you were in a fire that was federally declared disaster or a hurricane or whatever and had major damages associated with that event, that accounted. But if it was an isolated event that was just you're out of luck.
Right.
Um, Another category that got eliminated under the Tax Cut and Jobs Act for itemized deduction was unreimbursed employee expenses.
Oh yeah, that was the worst.
Yeah. So people who have day jobs where they have expenses, those used to be deductible. And you had to meet
Mhm.
certain thresholds and all this kind of stuff. They had to be above 2% of your AGI or whatever. But they were usable in some way. And then so like if you were we had a lot of people who were in outside sales. So we had one guy who was a liquor distributor for the state of Florida, and he drove the entire state every day. So he put like 40 or 50,000 miles on his cars, and he would buy a new car every 2 years because of this. And this
Right.
was all associated with his work and all was perfectly documented and everything. And so that was a huge source of deductions that just got wiped out for the Tax Cut and Jobs Act. Remember, I had another guy who was he wasn't a liquor distributor, but he worked for Cisco, the restaurant supply company. So the first year we were in the Tax Cut and Jobs Act, regime, he was sitting across the distributor. He's like, "Hey, you didn't ask me about my work expenses." And I was like, "Yeah, that's just not a thing anymore." He was like, "What?" So yeah, I mean, and so under the Tax Cut and Jobs Act version, if you have those kinds of work expenses, maybe you're driving around, maybe you are using your personal cell phone, maybe you have a home office for your day job. None of that stuff counts. So whatever that expense is, you either need to go after your boss for reimbursement, or you just have to factor in the fact that that is reducing your income, and
Right.
that's just how it is. So if the Tax Cut and Jobs Act becomes permanent, those things are never coming back. Some states still allow for unreimbursed employee expenses, like California, but it's state tax is always going to be a smaller chunk compared to the federal. Other things that are in the Tax Cut Jobs Act on the individual level that are a benefit for people is like the qualified business income deduction. So this is the huge tax break on pass-through income from S corporations, partnerships, things like that, and you can get up to 20% of that income tax free, depending on the numbers, depending on different uh, qualifications. Um, so if you're a partner in a real estate syndication, let's say, and it makes 100 grand, then maybe depending on the numbers, etc., you're only paying tax on 80 of it. So that's a huge tax incentive. And if you own your own business, like a lot of our clients do, then uh, it's a big swing. You can optimize your tax load significantly by adjusting the numbers and the payroll and all this kind of stuff to make that deduction as high as possible. Uh, we're going to skip the tariff thing for the moment, and then the one of the more recent announcements that Trump made, was exempting tips from income taxes. And the tax foundation saying here that in 2018, IRS W-2 data indicates 6.1 million taxpayers reported a total of 38.3 billion in taxable tip income for an average of 6,249 per taxpayer. Now, I will let you in on a dirty little secret. A lot of people who work tip jobs don't report all their tips. They're supposed to.
True.
Uh, it's such an issue that if for people who are in higher end places, a lot of times their entire actual paycheck is just paying Social Security and Medicare, their payroll taxes, because their tip income is so high compared to their base income that there's not enough money in their base income to cover just the payroll taxes. And so they end up having to kick in more when they file their income taxes. But this is a perennial problem because when people are tipping cash, then did they report it to their boss to include on their W-2? They're supposed to. We tell them they're supposed to. I don't know if it happens or not, to be honest. But I have seen a number of people get upset when they want to go buy a house that had a tip job. They say, well, why can't I get a mortgage? Because you haven't reported any income. The people who give you the money for the mortgage want to see that you can pay them back. So, that's a conversation I've had many times. But yeah, so how much of that 38.3 billion is real? No idea. Could be 45 billion, could be 50 billion. I don't know. But 6.1 million taxpayers is a lot of people, and I don't know whether it is. It's with Trump. It's hard to say. Is that a real proposal, or is this just something he's saying? Right. so, so I don't know. But it is an interesting one in that people who make tips are typically younger. So it could just be an interesting demographic to go after for votes. No idea if it'll actually come to pass or not, but it is an interesting idea. As far as like revenue for the U.S. government, 38.3 billion. The tax on that, let's say they're averaging 22%. They're in that bracket. What is 38.3 times 22%? 38.3 times 22%. That's $8 billion worth of tax income, which is enough to run the federal government for like an hour. So it's just not an issue. But it could be a good politicking kind of thing. Payroll taxes, no tax policies proposed, and then they've got this tariff and trades thing. So, Trump's big thing is tariffs on China. He wants to impose a 60% tariff on all U.S. imports from China. And he's talked randomly about, Chinese-owned auto manufacturing plants in Mexico, they're going to get 100% tariff and so forth and so on. So here's the thing about tariffs, is that, a tariff is a tax that a consumer pays on an imported good. So it doesn't matter that it's like, oh, we're assessing it on these Chinese companies or whatever. It's like, well, you're assessing it on the things that people are buying because that's what an import is. Somebody wants to buy something for some reason, and you're making it more expensive artificially. So, whether it's a good economic policy or not, generally most economists agree that it's not, but it is a populist talking point because it feels like you're getting back at an unfair thing. It's like, but I guess I won't get too far into that. However, there's another proposal that has been made to consider replacing personal income taxes with increased tariffs. So, okay. I'll give you the short version of this. There's no way this could happen.
Right.
And I'll show you why. So I brought up some charts from the Federal Reserve, St. Louis Fed, and this chart is the federal government current tax receipts, personal current taxes. So this is how much income tax is raised by the federal government. And in 2023 was basically $2.2 trillion. 2022 was a little higher, $2.5 trillion. It's like, okay, that's how much the government is, making, if you want to use that kind of language, in terms of income tax for personal taxes. There's a little bit more that's corporate, but personal income taxes is the largest chunk. And uh, here's the corporate income one. It was 409 billion in 2023. So, and again, this ties into what we were talking about, reducing the corporate income tax rate. The corporate income tax just doesn't raise that much money. It's mostly the personal income tax. So 2.2 trillion versus 400 billion. It's the personal income tax is 7 times larger than the corporate income tax. So by shifting the percentage on the corporate income tax, not going to move the needle that much. So if you want to address income tax, it's really the personal income tax that we have to focus on. But then when we compare it to tariff, so this is the federal government current tax receipts, taxes on production and imports, customs duties, which is tariffs. We're looking at, and this is 82 billion. So 2.2 trillion in personal income tax, 82 billion tariffs. In order to make that compatible, the tariffs would have to just be enormous. And then we get into the fact that people are not robots, right? So if we're buying a certain amount of stuff from imports, whether it's China or Mexico or wherever, and those things become 3 times more expensive, then people are going to stop buying those things, right? So, and that means that your projected number as far as how much income the federal government's going to make on those imports is going to be way off because of the elasticity of demand, is the economic term. So, so then that would mean it's like, well, we got to make the tariffs that much higher in order to make it, bring in the same kind of revenue for the government as far as the personal income tax. So, I mean, there's just no way this could work.
Right.
On top of that, you would need to pass some kind of constitutional amendment to repeal the income tax. So the income tax was created by the 16th Amendment to the Constitution. And before that, the federal government was funded by tariffs and duties and things like this. But, it had a much, 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 much smaller government that did way fewer things. And, if you had a political plan to eliminate the income tax, but still preserve the ability to have an income tax and then assess these crazy high tariffs, well, then what's going to happen in the future? Well, if they have the ability to have an income tax, then they're going to have an income tax at some point in the future, whether it's this administration or the next one or whoever. So what you really, really want to avoid is a scenario where you have the income taxes and super high tariffs, because that's just killing all economic productivity. You could make an argument from a protectionist standpoint. It's like we want to incentivize American businesses. I mean, economically, that's wrong, but it does resonate with people, and you could do that. But the only way it could possibly work is if you actually repealed the 16th Amendment to the Constitution, and then as part of that package, and then created the tariff. Getting the one without the other would be a disaster, because we all know what happens over time is that the Congress in 2030 is not going to care what Congress in 2024 said, and they can pass their own rules. And if they have the ability to do an income tax, then they're going to do it. Because I don't know if you know this, but government's broke. Despite all the money that is created, and despite all the money that they pull in through tax policy, it's just there's nothing there. It's all IOUs. So the whole notion of replacing the personal income tax with tariffs is just crazy. And notice that they specify personal income taxes, so they still want to preserve the corporate income tax, which means that they're talking about not repealing the 16th Amendment. And I cannot see this working at all. Assessing a punitive tariff on just China, yeah, I mean, then you're just penalizing goods made in China. And you could theoretically say that, okay, now we're going to shift things over to Vietnam and other low cost manufacturers, which is already happening to a large degree. But putting it across the board would just be insanity and would drastically lower American standard of living just by forcing prices up on everything. Uh, so yeah, there's that, and that covers kind of Donald Trump's tax proposals. So business corporate taxes lowering by a few percentage points, making the Tax Cut and Jobs Act permanent, essentially. Oh, the other thing that I forgot to mention on the Tax Cut and Jobs Act is bonus depreciation. So bonus depreciation was basically an incentive for companies um, to buy assets, whether that's equipment or real estate or whatever, because it gave, instead of having to write them off over several years, it allowed them to accelerate that depreciation into year one. And so that was hugely beneficial for companies, or people too, people that have their own businesses and things like that. And so I would love to see that bonus depreciation be reintroduced in its full form, because we have a reduced form right now. But yeah, I would love to see that go back to 100% in year one. That'd be great. All right, that kind of covers the proposals here. So the net of all of this is that, you know, the Trump's tax proposals is kind of keep things as it is, tweak them to be a little bit better for individuals, and imported goods from China are going to get more expensive. So that's sort of the net of everything. And I think we still have a couple minutes left. So Serena, why don't we do one? I want to call it a caller question, but we're not on talk radio back in the '80s. So what questions have we gotten from clients over the past week or so?
Right. So, real quick, Neil. So the imported goods, that it's going to be increased, like the prices are going to be increased.
Uh-huh.
What's your take? Like, what do you think? What's the why behind it? Why do you think he's doing this?
Well, the why is the protectionist argument. We're saying, China is taking unfair advantage of us
Yeah.
because they have their low-priced sources of labor and they're dumping goods on us cheaper than Americans can compete with. So the dumping goods on us cheaper than Americans can compete with is true. However, it only works because people want to buy cheaper stuff. So, you know, it's when you look at it on an individual level, it actually doesn't make any sense, because it's like, well,
Right.
I'm sitting here at my desk. I've got two monitors that were made in China. I've got
Mhm.
a printer over here that was made in China, and all this other stuff that was made or assembled or whatever in China. And so I bought these things because they were the not the cheapest, but the most cost effective ones for the things that I wanted, right?
Mhm.
And if you just artificially make that more expensive, then you're just costing me money. But if you don't think two or three steps down the road when it comes to these things, then it's well, they're pricing out American labor, which they are.
Right.
But it's because American labor costs too much.
Right.
So
That's true.
you know, do you want to make less in your job? Because that's kind of what it's saying.
Mm.
You want to artificially reduce American wages and artificially increase, Chinese costs. So
Right. So this is kind of his way of keeping everything in America
yeah,
in
yeah,
its own way.
absolutely,
Yeah.
yeah.
Without doing it, actually.
Yeah, yeah, I mean, there have been a lot of economics works done on tariffs and free trade policies and all this kind of stuff. And basically, the optimal policy when it comes to individual prosperity is there should be no restrictions on anything. Uh,
Right.
the 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 place where I think you can make a where you can make an argument is like, okay, given that our country has certain standards as far as child labor and environmental protection, and these other countries don't, then you're creating an unfair competition. And it's like, yeah, I mean, there is something to that, but it's not 60%.
Right.
So
Alrighty. So that
and
was
it
one of
is,
my questions, Neil, that I had. I was wondering what your thoughts were on that.
yeah, yeah. So I mean, my preferred thing would be a hands-off policy, but
Right.
that's not the world we live in. And it is starting to storm
That's
here,
true.
so if I cut out, That's what happened.
Yeah, same over here, but it's okay. We're gonna make it through.
All right.
So really fast, we do have a question that came in, Neil, a tax question.
Uh-huh.
A client wants to know how can one manage taxes on investment income such as dividends and interest?
Yeah. So with difficulty.
Right, right.
The issue with investment income is that most of the time it's out of your control. Um, so you own some stock and they decide to issue a dividend, and your 0.00000 whatever percentage voting share, you're not going to have any real effect on that decision. So you're either going to get the dividend or not. And what you do with that dividend is, some people reinvest it, some people take the cash, most people reinvest it, and it's you're just kind of stuck with it. If the numbers are large enough, then there becomes strategies as far as how you want to hold that investment. Do you want to hold it in your personal name? Do you want to hold it in some kind of entity? Um, so there's that aspect, and then if the numbers get really big, then there are capital gains strategies. There are trusts you can set up to do different things, but that's way on the extreme. That is not a common thing that we see. So I was working on somebody's return earlier today. They had $800 worth of interest and like 2 grand worth of dividends, and that's just you're just stuck with it essentially. Um, but if it's interest or dividends from an entity you control, not some third party Wall Street thing, then there are options as far as like, well, how do you want to structure this income? Should it be a dividend? Should it be interest? Should it be a loan? Should it be a reimbursement? Should it be this, that, the other? Then we can start to ask those kinds of questions and figure out what the optimal path is. But if it's just stock that you own on the stock market, you're just kind of stuck. Or if you have interest from a bank account or a CD or something, then yeah, it just is whatever it's going to be for the most part. Now, outside of that, I will say if there are strategies that will affect your global income that are not necessarily related to those categories specifically, and then those categories will move along with everything else. If that makes sense. So let's say somebody has, when all the jobs and the income or the interest and the dividends and the capital gain, everything added together comes out to pick a number $300,000. It's like, well, if we take that from 300 down to 250, the whole tax picture is getting smaller, and so even though the interest and dividend is not affected directly, the the ending result is reduced. So you can think about it that way, because really what you're taxed on is your adjusted gross income. So after everything's added together and all adjustments are made, then where are you? And that's kind of the number to target as far as what kind of tax picture you're looking at.
Understood.
And let's do one more.
Okay, so really fast, Neil, what's your favorite tax strategy and why?
It changes depending on what I'm looking at. So I'm actually still writing a post on this. Been writing a post for like a month on this, and I'm calling it the climbers strategy. So many people have heard about hiring your kids, putting your kids on payroll, and this is a next level to that strategy where basically you can make your kids into billionaires, and you can do it for free. And that's by putting them on the payroll and paying them enough in order to contribute to an IRA. And it's free because the tax savings that you get is actually almost equal to the amount that you put into the IRA. So it's even Steven for you, and then your kids get set up for success over the long term. And
Mhm.
I'm a big fan of putting the kids on payroll. Not, I mean, the tax benefits are nice, but more than that, it's the lessons with money that are, I think, more important. Because I don't know about you, but when I grew up, or in my family, we learned nothing about money. My dad didn't want to spend money. I knew that. But as far as what do you do with money? How do you save? How do you invest? There was nothing. And most families, I think, fall into that category. So I've got two siblings. When we all got into our 20s, each one of us got into different levels of trouble, money wise, because we just didn't know anything. And so by having those lessons early, from starting at age, 8, 9, 10, something like that, and going, to their legal adults at 18, then you get to put those lessons in those kids' heads early on so that you can set them up for success. And so you whether you do the climber plan or not, uh, that's a separate decision. But just the fact that your kid wants whatever, the new Xbox or the new shirt, or I want to go to the dance or whatever it is. It's like, okay, well, you have this money that you've earned. Do you want to spend it on that? And just that question alone starts getting people to think. It's like, well, do I really want that? Do I want to save up for this car that I want to buy when I'm turn 16? All these sorts of things just automatically kick in just by having that question. And then you can go deeper than that by, going into, savings, investment, charity, all those kinds of things. But even at its most basic level, just asking the question of, do I want to do this, knowing that I have an opportunity cost. If I do this, I can't do that. Most that never occurs to most kids because they're never faced with that. So by establishing that pattern early, I think you are doing your kids a huge benefit. So currently, that's my favorite strategy. But it does change depending on what I'm looking at, and basically, when it comes down to it, they're all great.
Right. Sure.
Because they're all putting money back in our clients' pockets and not in the government. So that's what I get a thrill out of. All right, we are at the hour, and I guess we will call it there. Normally, I have like a closing slide, but I'm going to be changing that here in the next little while. Serena, I don't think I've told you this, but we are going to be doing a workshop in a couple of weeks, and
Oh, cool.
it's going to be on the summit sessions strategy, and I'll have more about that in the next couple of weeks. And otherwise, we'll do this all again a week from today on Tuesday at 6 p.m. Eastern. And if you go to taxsherpa.com/live, I will update that link here in 5 minutes, and then it'll take you to the streaming page for the next one. But other than that, that's all I got. Any last words, Serena?
Uh, Come see us if you want your peace of mind back. We're here.
Because you want your peace of mind back. I like that.
Yeah.
All right. We'll see you guys later.